Good morning. My name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to today's morning call. It is Tuesday, another day getting going here. You know, you look overseas and you have the Nikkei down 5% or so. Had a small bounce back and now it's like on monthly lows. Their whole negative rates news was taken back as, you know, pretty much reality set in that that's probably not the best thing for banks, which have been getting absolutely annihilated. You know, on top of that, you know, we've talked about in my note, watch 9,300 on the DAX, you know, that once we get below there, you know what, the markets are going to notice and the DAX went below 9,300 and there's no real bounce there. So the market environment has been very weak. The technicals pretty much everywhere have been broken. So when that's the case, hopefully you're in mostly cash and you're just day trading. Because you put on top of the rules that we try and set out there where if stocks are above the 8 and 21 day, usually traders are high-fiving, you have a swing account going with 7, 8 longs, there's momentum there. You break the 8 and 21 day, you know what? No momentum, you get neutral, you get tactical. If you're below the 50, the 100 and 200, chances are you're in downtrends, chances are there's you know, weakness everywhere and you want to have risk off. No opinions. I was even just talking on the chat room and everyone's like, what do you think? Do you think Draghi is going to let a European bank go bankrupt or falter, et cetera, et cetera? I'm like, who knows? You know what? Back in 2008, no one knew Lehman Brothers was going to go bankrupt. No one knew what was going to happen to Bear Stearns. You had things going on everywhere. Even fast forward to the past year or two, did people think Chesapeake was going to go to $2? And the carnage in some of these oil names? You never know. But if you're in the right stance, you won't get taken to the woodshed. You know, if you have the right process where you do a level versus a level during price discovery, you know what, you can make money, you might get some small paper cuts, but you stay in business. So anyway, we come in today, we're still above the 2016 lows, the new ones of 1812. Question is, with the futures down 15, do we hold them and go green, or is there more downside? If you look here at the chart of the SPX, oh, I have the weekly up, so I might as well show you. Okay, you know, we've been talking about this chart and talking about, you know, time frame and what could potentially happen. You know, and if you look, you know, at just the macro picture, remember this double top we took out back then? Oh, that was fun. That was at 1576. Well, you know, since that 2009 low, we've done nothing but rally. Rally, 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 rally until, you know, right here you could look, one of the trends was broken. And before that, you had the accelerated trend, which is what we usually trade, which broke. So first signal to get out of the way, second signal to get out of the way, and now we're sitting here, you know, right around you know, this 1840 level. So although we feel oversold, chances are a lot of people say we should never have gotten that high with the Fed. So anyway, you know, this is some major support which we're trying to hold. If this were to give, okay, you know, you have a bunch of levels underneath it. One of the levels I keep talking about is somewhere around the 1770, you know, and then you also have the measured move that could take place at some point later this year, you know, from wherever 2100 to 1850, you turn that over 250 points. That takes you down to pretty much around the 1600. Okay, but what do you do between now and then? you trade, okay, and you have to maneuver the markets. So if you want to take a snapshot of that picture, that's the macro picture. But then, you know, a lot of us do trade the micro, and we talked about that on Friday. Will the spiders break below 190 or 1897 the futures? If so, this lower you know, trend off of that 1812 low is in jeopardy. So get out of the way, maybe get short. You know, and obviously LinkedIn and data and all those high beta names that blew up helped the course. So you go back to the daily. Let's go to the daily chart now of the SPX, okay, and check out, you know, where we are. Oh, it actually gives you a little bit more of a snapshot. So, you know, you want to take a look like this, okay. Oops, I just lost my lines. You know, here's where one of the trends broke and what were we below? All the moving averages right there. Okay, so now what are we trying to do? We're trying to hold, you know, first thing was trying to hold, oh, here we go, back there we go. This was the first low, double bottom, which we broke, created the new low, and now we're right here near it, okay, with levels underneath it. So depending on whether we hold here and bounce, will be the velocity there. So let's go a little bit closer up here, okay, so you could, you know, kind of see how we're going to try and dictate or trade today. You could probably even go to an hourly. It looks a little bit better. So, you know, here is yesterday's low. Yesterday's low is one of your pivots, 1828. And then here is the low of the year now, 1812. So question is, do we hold a little bit higher and try and, you know, continue to hold this lower range? or do we break below it, which it's going to be hard to tell. If you go to the spiders, you have this gap open. So some gaps like to get filled, some don't. This gap didn't get filled, and that helped give us clues that we were going to be heading lower. Now you have this support that we were trying to hold here, 187, and we gap below it. Okay, and will this open gap stay in or not? So here's your point of reference in the spiders. Here's your next one. If we were to hold a little bit higher, maybe around, who knows, 184, and try and go green and push above 186, maybe there's a move to fill this gap and even go a little bit higher, but it remains to be seen. This is, you take a snapshot, and this is like resistance 1, resistance 2, resistance 3. Here's support 1, and then here's your big support. So what's going to help us give us clues on that? You have oil now that was up a little bit, now below 30. It stays below 30. That's going to add pressure. Yesterday, the XLEs were the first sector to go green. At this point, I don't know if you can go back to them, but ExxonMobil and Chevron was pretty strong. So draw your line right here. This is somewhat constructive if it could stay above 54. If it breaks below 54, get out of the way. It's still below the 8 and the 21 day. Still, a broken sector below the 200 day. All of these friggin', moving averages up there. But chances are, if we were to have some kind of rally and oil stabilizes, this could give you a move above yesterday's high to test the upper end of the range. So at least you have that to go with. In the technology area, that played downside catch up fast. You've had lots of different areas to sell. When it broke the 200 day, which you get out of the way, especially when you stay below to start the year, and then even more pivots as it's gone along. So here is your 200 day. A lot of moving averages right there. Broke below, stayed below. Then you had this rising wedge like everything else. Okay, broke below. So the question is, this small hammer bottom, does it stick? I don't know. So in 94.84 is yesterday's low. See if it holds a little bit higher. If you start to see some high beta tech go green, maybe again there's a Q trade above yesterday's high to fill this gap and then probe a little bit higher. But remember, these Q type of trades, okay, could turn very ugly as these trends are now lower. It's below everything. It's broken. Okay, so if you try and catch Q trades, it can make you ugly real quick. So today, I'm thinking maybe you could be a buyer versus low, but if it breaks this low, get out of the way. Okay, there's a lot more lower prices beneath there. The bios are broken. Bios made new lows on 2016. You had this ascending channel below the moving averages, broke to the downside. Then you had this one right here, broke to the downside, and then you had this support that tried to hold that broke to the downside. And look what it's been doing. It's been below the 8-day moving average this entire time, so that's friggin' weak. Back in the day, when it was above, all the moving averages, it was trending really nicely. And now it's been below. This is actually a snapshot of the macro here. This is when it broke this ascending channel, broke this ascending channel, this one, and, is it oversold? Yes, but it doesn't need to rally because, again, some people will say, oh, look, where we came from. And it's getting down into some areas here. I think, on a macro sense, what would this friggin', look at this 220 here. This 220 would be pretty significant. Maybe that's when, the bios finally, get a real bounce. If not, a day trade today. But, lots of broken structural damage. First you get technical damage, remember bent, then broken, then can it stay broken, and then you get structural damage, which means things have truly changed for a foreseeable future. All right, so let's go into where maybe there's money today. Yesterday after 5 to 6 down days in tech, they tried to rally. So maybe today, some of those buyers that showed up at 2:30 yesterday come back. So let's go one by one. Google was the strongest yesterday to go green. So let's take a look here on a close-up level. We gave you guys the strategy on how to handle earnings. Would it stay above 800 or would it break? Okay, well, it broke, and if you got out here or got short there, you did very well. Okay, at least you had some flexibility to see if it could hold the 200 day the first time, which it did. So I guess go to the 5-minute because this thing moved fast to see, maybe where it could hold to go green again today. Okay, you could almost draw a small, descending channel here that it broke right there. So I would say the 694-ish area, which would be about 50, this would be easy. If it holds 697 and then goes green and pushes, that'll be an easy day trade for people. If it comes to 697, doesn't hold there and pushes below, it's probably going to be hard to hold based on where it came from. So I'd say 697 is one support, 694 is another if it was going to try and go green and show some relative strength. But again, these things from day to day change. Remember Amazon? Amazon actually gave you that day trade here. Remember that day trade here where everyone's, oh, Amazon's going to go again. Then it opened lower. You tried to buy it, and if you didn't get stopped out at this 2-day pivot, you got taken out to the woodshed. So, this has been very weak. This, too, had your breakaway failure. Then you had your gap down after earnings. Then it broke this 570. And then it broke the pivot lows of the year, and then closed below the 200-day. Now look. So lots of signals along the way. So now the question, I guess, for Amazon, which it was the weakest one yesterday, and the last to go up, I tried to trade it, and it was not easy. So at this point, it's probably off $3, $4. The low is $4.75. See if it could hold it, and if the market tries to go, maybe this goes green for a push. But again, this has changed. It's in a downtrend now. It's below every moving average. You have to be very, very careful. Same thing goes for Netflix. Netflix was actually the first stock that gave you the shot across the bow after earnings that it wasn't going to be strong when it failed at 116 after hours. And then it lost a 200-day weeks ago at 101. So if you missed it after earnings and you sold it when it broke the 200-day at 101, you're like, down at $80, let me give it a try, or not. So anyway, it did go green yesterday. Here is this, your descending channel that it couldn't get above after earnings, and this is when it broke the 200-day right there. And yesterday gave you a small green day. Hey, big deal. But there was cash there if that's what you wanted to do. Down a few bucks, up $1. Hey, that's how you make day trades. So today, with the futures lower, maybe it tries to hold this again. But remember, the last time it tried, it got engulfed. So at this point, I would say 79.95 is the point to trade against. And I would say if anything could try and go green and push a little bit, maybe it's Netflix. That's something I'm going to look at, today. Then you have in social land, LinkedIn was the one that got clobbered on Friday. But then yesterday, the first half hour, there was a nice trade there. Flo came out with some, a good call saying that, Citron was actually positive on it. And then, it showed some good price action and had a quick pop. Will it do it again today? I don't know. It's been absolutely annihilated. So I guess if LinkedIn could hold yesterday's low at 106.72, maybe it gives you a red to green trade for something. And then this is yesterday's high, and this is the earnings low. We'll see how long it could stay above that. Facebook, you never know what's going to truly happen. But all in all, if we're looking at the stock and said, oh, look at this, it's had a big 1, 2, 3, 4-day move into a doji. Let me sell it here and see if it could hold the prior high on a pullback, to be a little bit more precise. Well, you had your doji. This was probably a spot where some people either definitely got out or got short when it confirmed that doji is meaning a break. Here's when it bounced off this 110.55. I was in jury duty, put a trade there, made some money on it, but then after you do it once, you might not do it twice, and then it broke. And then here went into the earnings gap, and now this is what you have to trade against. This is maybe this was a topping doji and this is a bottoming doji. You don't know. But anyway, it's down $1.50. Most of us will look here to see if it holds 97.46 to see if it can go green and show a little relative strength. But I have a feeling, now this area is going to be just such a boatload of resistance considering it's getting broken. It is one of the few names besides a Google that's above the 200-day. So, it's still deemed one of the more relatively stronger names. And then you go into what's it called, Apple, which was stronger yesterday, went green. Still, a gross pattern as far as this gave us some clues of this. You still have this head and shoulders top pattern. Here was your left shoulder, the head, your right shoulder. And then if you looked at this ascending channel when it broke below the 200-day, that was your way out. And now it's hovering near the lows. So maybe today, buyers come back and take it from red to green. But all in all, this measured move of just say if people want to draw the neckline here, which it never filled. I don't know exactly where everyone was drawing it or where I would draw it, but ultimately, if we break 1810, I'm going to think we're going to break below this 92, and chances are, at some point in 2016, you might have an $85 stock or even lower. Okay, here's the gap there. So just don't blindly buy Apple, but recently it's trying to hold. And we'll see what happens today, relative strength-wise, if it could. Actually, let me give you a snapshot of that real quick. That's yeah, that's basically in a left shoulder head, ascending channel, broke to the downside, small bounce, boom, and now it's trying to hold there. But here's your real big support, in my humble opinion. But obviously it's going to have to get below 92 and stay below it for that. And maybe today for a day trade, it's down 90 cents. It goes green. I'm going to look there also. Then Microsoft did something different this quarter. It gapped up after earnings, and the reason why I talk about pivot gaps after earnings is because if they get filled, there's no strength there. Gapped up inside day, here was your out. If it doesn't hold the earnings gap, it shows you no momentum. Here it held the earnings gap and still was hard to get upside. This one, boom, to the downside, and now it kind of tailed off that. It's very broken, but maybe today with the futures off, it's one to go green. So, coming into today, you have a lot of sectors, that have broken, battered, and bruised. You have some more oversold than others. Yesterday you had some act better that went green first. Google went green first. Netflix went green first. Other things have just been, hard to go up. So, in this type of environment, you want to be much more careful. So today, if you go back to those names and they don't show you the same composure as they had yesterday, don't get stubborn and just buy if they break yesterday's lows, etc. They're in the game for maybe continuation, but it doesn't have to happen when you're in a brutal tape like this. Let's see, let me go back to gold. Gold has been in an unbelievable trend. Dennis Garmin came out yesterday and said buy gold. I think he did say wait for a pullback, but here's your bit of a topping tail. The spot to have bought gold was in this area, okay, or when it took out this pivot right here, this 106, or when it reclaimed the 200-day. To buy it up here might be a little bit tougher. So I would say see if GLDs hold this gap, okay, for now. If it doesn't hold that gap, it then gets filled. I would say a better buy would probably be, right here. So we'll see what happens there. If you look at the longer term chart of gold, again, you just don't want to be blindly shorting it because it's been almost a 3-year bear market where, on the macro sense, this is when, you had your trend change, your pennant break, you had support broken, boom, that was your out, or this was your out, and now, it's in this descending channel here where it's actually poking its head against it right now. So see if, it could break it. But first time you get there, it probably is a better sell than a buy. That's a snapshot of the more macro picture of the GLDs. And in closing, we'll see what happens. I think guys that are coming in flattish are doing better than those, trying to pick which way the futures are going to gap, because then you have to either start behind the 8 ball or not. Today, I do think that there might be an attempt to rally, to continue what happened yesterday. There might be some people caught long because they thought yesterday was the huge reversal and we're going to go off to the races. So if that's you, what I would do is let it put a 15, 30-minute low and maybe buy verse at, and if things can't rally and you see weakness, breaks that low, just get out of the way and call it a bad trade and then live to fight another day, versus if breaks it, you're buying, trying to get saved by the market, because that did not happen. A lot of people did that last week and got blown up, thinking after 3 down days in high beta tech, you're not going to get a 4th, but there wound up being a 4th and a 5th. So try and take your thoughts out of the equation and let the action speak for itself. Have a great day trading. I'll see you at the recap.